Hello, everyone. Let's get into it. Right now, there is a building, 95% occupied, rents collected, NOI is growing. There's nothing wrong with it. There's three entities attached to this. The sponsor who put this deal under contract is presumably running it as the operator. The lenders that lend to finance this building and the investors that invested in it. All of these people now are in trouble. These are not assets that are distressed. This is a story of sponsors, lenders, and investors who are all in trouble. And this is the entire market in a nutshell.
That's a bold opener, Omar. We welcome everybody. I'm looking forward to this story. It's that bold opener is exactly why people should watch this episode. So, for everyone, this is the seventh in our monthly series. The first five webinars they look back how the stacks broke and a generation of sponsors lost. And full disclosure, before we get ahead, 33 deals in Boardwalk Wealth. And thankfully, and I mean that sincerely, thankfully, zero foreclosures. But today is not our story, it's the markets. So, the perspective of this webinar is going to be forward looking, what's about to come loose, and who gets to catch it. Before we talk about who is in trouble, Omar, I'd like you to prove that the building is fine. That's really what I don't think anybody expects.
Look, here's what the market is doing. In Q1 2026, we're going to get into details, but net absorptions are up materially. Completions are down materially year over year, and forecasted deliveries are supposed to be something like the lowest since 2014.
So I know we're not showing that on the screen, but translation for anyone who doesn't live in this, and trust me, we're not talking about rocket science or anything like that, but the absorption is just demand, as in apartment renters actually filled. So it went from negative to 78,000 in one quarter. Lay that out for us, Omar.
Look, for the first time in 3 quarters, demand is outpacing supply materially, and supply is thinning fast. This is a lagging effect of rising interest rates finally hitting the market like a truck. And these are the lowest amount of completion since 2014. So more than a decade. But this quarter is not the point. The issue is that this demand is structural and it's durable. Think about this. It's not like the concept of housing has gone away. Now, if you're in the office industry, which is a contrast we'll make a lot of times, there is a structural confusion of whether do we actually even need this office space fundamentally.
Right.
That's not the issue with housing. For years, though, by the way, people left apartment buildings. They graduated into buying homes. That exit, as we all know, has stalled for structural reason.
Hmm. So renting is cheaper than buying for sure in most of the country right now. Does that not pull renters out? I don't. Let's explain that, please.
Look, renting is cheaper by and large in most major metropolitans in America, if not all of them. But people still cannot buy. You gotta read the numbers. Pretty much half everyone with a mortgage has a rate below 6%. We just found out, I think I read today a report that the Fed is guiding towards mortgage rates hitting 7%. Yeah, 7%. So
Ouch.
about three-fourths of the people with mortgages below 6%, which is about half of the mortgage holders in America right now, they're not gonna move. They're the
Right.
seller
There's no
market.
option to them, right?
Oh, no, because think about it. I mean, they sell their homes. Now they go somewhere else. Even if it's the same value home, their monthly payment is just going to skyrocket.
Agreed. Yeah.
That resale supply, right? Where you sell a home, you buy a home because everybody's not a billionaire, right? So she's going to sell a home, presumably, to buy your next home. Well, that market is completely frozen because people are not moving. And for the would be buyer, let's assume somebody has a good job, good income, not a lot of debt, so they qualify traditionally. The problem is not the monthly payment, say for the house, for the mortgage and all the associated costs. The issue now is just the sheer volume of the down payment. And
Mm.
not everybody has an unlimited bank of mom and dad. So, I mean, you can't finance a down payment. So the issue is, even though technically these people can afford the monthly payments, which is really how the banks look at it, they've got good jobs, good credit scores, not a lot of debt. They literally cannot afford the down payment.
Right.
And renter base at the top continues to widen as renters by choice keep coming in. So, to give you a contrast, I believe renters over the age of 65 are up 30% in the last decade. Most of these are renters by choice, by the way.
Mm.
So this all of this onslaught of demand is not taking away. Let's assume if rates go down 50 bips, 100 bips. This is not a interest rate driven demand. This demand is structural. People need housing in good times and bad. And rents in the last few years got soft because we built too much. This is economics 101. I don't know why we complicate it so much. It's not because people want to now live in pods. They want
Right,
to live
right.
they want to have housing. It's just that
Yeah.
we built a lot of housing, so rents became soft.
So this might be an obvious question, but with the building full and demand still real, very much alive, why is not everyone just selling?
Well, one word: bridge loans. And as the word implies, it's a bridge to something, right? It's a bridge to stability. Typically, these are short term, say 1 to 3 years, floating rate loans, higher leverage points, and they are usually carrying the property as it's renovated. Maybe the property is underperforming, it needs a lot of renovations. Well, unless you don't have 90% occupancy, you're not going to get agency financing. So you're going to have to go towards these short term loans. And they have skyrocketed basically the rates over there. So what you're having is you have a lot of these loans that are expiring at the same time. So now picture this: you've got a good operator, solid operator, honest person, sophisticated. They don't run a fraud. They're great people, track record. Now, as the interest rates have risen spectacularly, this is unprecedented 500 basis points increase. Their interest payments have skyrocketed. Their loans got tight. So they did the right thing. They took their own money, they protected their investors, took their own money, invested it into the deal. They did
Right.
the responsible thing.
Yeah, isn't that exactly what we would all want our sponsor to do as LPs?
Yeah, but here's the problem: that capital now is stuck because interest rates continue to go up. Now, the sponsor, let's assume, now goes to raise a little bit more equity. Investors, understandably, are skittish. They might think, I don't want to put good money after bad.
Yeah.
So there's just no outside equity available to these sponsors. Now, what happens is you have a competent sponsor here, a viable asset. It just temporarily dislocated. The sponsor has done the right thing. They personally max themselves out. They have no more liquidity. And the only thing they need is a little bit more equity, most of the times, not all the times, to save their deals. So it's not like the buildings are failing. It's not like the sponsor is incompetent. It is just that the sponsor has run out of runway and run out of time before the buildings have.
Right, right. You're treating this as a scaled problem, right? How are we sure that this is not just one unlucky guy in
Well,
the playground?
I mean, look what's coming due. Your loans are maturing 56% above 2025, just in 2026. Of the loans that are maturing, I believe 40% of them have rate caps, which synthetically make the interest rate go down,
Yeah,
expiring before the loan matures, by the way. And of the loans that are maturing, I think close to I believe like maybe 50 to about 60% of the loans that are maturing, they do not even comfortably cover their debt service payment right now.
yeah, that's crazy. That's crazy. Just for everyone's information, DSCR, debt service payment, really, or DSCR is the debt service coverage. Okay, so that's income divided by the loan payment. And right now, maturities by end of 2026 are for the most part below 1.15x to 1.1 or 1.25x. And when that happens, the lender really starts asking hard questions. And again, there's $162 billion, up more than half from last year.
It's more like 56%, by the way. So, and $115 billion of these, by the way, $162 billion loans, well, they cannot even cover their debt comfortably.
Yeah.
Now, on top of this, you add that 40% of these have rate caps expiring before their maturity ends. So, which is the rate caps are a topic we've discussed in an earlier webinar. Basically, they're a way to say, let's assume you say rates are going to rise. So, you're buying an insurance product to reduce any exposure you have to rising interest rates. Well, 40% of these troubled loans have rate caps expiring before the loan matures. So now the problem is you have a synthetically smaller interest rate payment that is already pretty hard for you to finance. Now, the insurance you bought is expiring. So this number will go up. So now, if you couldn't pay a smaller amount, how in God's name are you going to pay Oh, Carson, are you going to pay a bigger amount? And an example of this recently is a top 50 Dallas based, top 50 apartment owner in the country, Dallas based operator, very sophisticated group. They just announced to their investors that they raised $400 million in a fund. All of that is gone. All of it. Not like, hey, you're getting no return. No, you've lost 100% of your equity. Now, by the way, they're going back to their same investors to try to buy still viable assets out of this vehicle. But the issue is again, this is a smart op. This is an example of a very smart operator. They're not a mom and pop operator operating the back outside, out of the back of the trunk of their car.
Yeah, yeah. So again, the point you're making is this is a structural issue. The assets were fine. The assets are fine, but the fund is still failing. Is that correct?
Yeah, yeah. Look, these buildings are fine because there's inherent demand. You have a lot of demand.
Hmm.
The capital stacks financing these buildings. We've discussed this, I think, in one of our earlier webinar, broken capital stacks. That those are the issue, and the issue now is these are not bad buildings that are going to change hands. So it's not like, oh, this building is collapsing and now you got to come in and do this. These are good buildings attached to people who have just run out of time.
Yeah, yeah. So we've spoken about one character in this story, the sponsor. The sponsor's being squeezed. Totally get it. We've walked through that. But the lender, they hold the note. So second character is the lender in this equation. Why would the lender ever be in trouble?
Look, this is a part I think not a lot of investors see or understand. The lender is squeezed as well. And this is because the lender also has a lender. Think about it this way: the same way as a sponsor, this multifamily sponsor, comes and says, I want to buy a building or I have a fund. I am going to raise, I don't know, 20 million, 30 million, in this case, 400 million of the guy who lost all the money.
Yeah.
And I am going to get financing to say if I raise $400 million, I'm probably going to buy $1 billion worth of assets, right? Because the rest is financed. Similarly, a lender that goes to raise a debt fund will say, I have raised 20, 50, $400 million, but they will also get lending. They will
Mm.
also get lending to increase the size that they can lend at.
Right.
And the problem is one or two bad loans going awry. Okay, you can kind of sort of figure it out. It's not the end of the world. These are big funds. You foreclose, you work it out. Things happen. But once you have a whole wave of these loans hitting you, the sponsors are now in trouble. So now the lenders are in trouble. When all
Mhm.
of these are hitting you at the same time, the lenders are now seeing the writing on the wall. They're calling their warehouse lines the back leverage. So the lender that you borrowed from has also borrowed money from somebody else.
So the same awkward call that the borrowers are getting, the lender is getting, and by that I mean they're getting the same kind of margin call.
Yeah, because look, think about it this way: if you're a big debt fund, you got a couple of $1 billion. Let's assume your back leverage or your warehouse line of credit is with Wells Fargo or J.P. Morgan. Well, Wells Fargo and JP Morgan are not, you are not the only person they are providing a warehouse line of credit to. Wells Fargo and JP Morgan, because they're money in central banks, they're doing this for, I don't know, all of the major lenders in the market, while they also go and lend, by the way. So it's not like these are unsophisticated people that do not have real time data telling them what is going on. They see the writing on the wall. Extend and pretend is done. The lender's lender now is saying you got to clean up your books, eat the loss so you make us whole, the same way that this lender is telling the sponsor make us whole, right? So now your lender is getting pushed into an issue for a structural reason, not because they feel like, okay, long term the value of this asset is not going to be there, right? They know long
Mhm.
term there is a demand for this asset. It's just that for structural reason they have been pushed into this thing. And look, this is sort of like an existential issue for a debt fund. If you run an equity fund, let's assume somebody's got a $100 million equity fund, $100 million debt fund. With an equity fund, if you have a few losses, you can recover your losses because equity returns are typically high. So you have a hope of recovering something, right?
Mhm.
Okay, maybe it's not the best outcome, but it's not the worst outcome. Well, the problem with a debt fund is that at best, you get your principal back and interest. That's the ceiling. It's not a floor, it is the ceiling. The best case outcome is you get your interest and you get your principal back. So even a few losses, especially that are sequential or happening at the same time, they can destroy even a big debt fund. And the debt fund money, you have to understand, this is like go to sleep money, right? Somebody says, hey, I will give you a 6% coupon and this is go to sleep money. Well, this go to sleep money has now stopped people from sleeping.
Mm. So the lender has every reason in this instance, given that explanation, to move fast.
Yeah, they have a lot of reasons to move fast, but again, the biggest thing is you're not going to see a lot of this, say, in the Wall Street Journal till things become really bad, right?
Mhm.
Till the great financial crisis didn't happen, you didn't see Wall Street Journal, New York Times covering it. These are private transactions, especially on the institutional side. It's not like you're going to just hear about them in the news. You have to be, you got to have relationships. You have to be in this line of work to see all of these things. And to give you some example, foreclosures now are more than special servicing or modifications. So that did look. My point is, this is all a pressure. It leaves a public fingerprint. But the only way you're going to know this is if you're in this line of work, you deal with all of these people like us, and you have all of these relationships.
Right. So special servicing is where a troubled loan goes to be worked out. 2 years ago, the industry led with modifications. How about now?
Yeah, well, 2 years ago, the industry was doing extend and pretend. So the amount of foreclosures versus modifications were more. Now, when you have impaired loans, something like 39% of those times you are going to have a foreclosure, and only 20% of the time you're going to have a modification. This is again not a comment on the building, just a comment on the capital stack. The building is still printing money. So, and the reason why this is happening is that the chain above the lender that is forcing a sale. So just remember, a lender can carry one bad loan, two bad loans, maybe a few more. They can't carry 100 loans that go bad at the same time. And their back lenders now are done extending and pretending. They want the losses to be recognized now so the back lenders can be made whole.
Right, right. And that is the sponsor and the lender, and is part of this story. But there is a third character, and that's the balance sheet. And that's the one people watching are sitting in, you, me, our investors. So a lot of you are in a deal right now where distributions have paused. The updates for sponsors got shorter, or you probably got a notice asking for more capital. The instinct naturally is to pull back and fund nothing. That instinct is completely rational. And here is the uncomfortable part, Omar. Tell me if I have this right. When investors refuse to fund anything, the operator with the viable deal then has nowhere to go. So, again, we're talking about how the deal is not necessarily broken. So, an operator with a viable deal, when there's nobody willing to fund, they have nowhere to go. So, the investors pulling back is part of what strands a good sponsor.
Yeah, look, you have it right. And each party, look at isolation, is doing the right thing by protecting itself. But now it's like tightening this noose on everyone, including themselves.
Right. So then the honest thing first, if you lost money in a syndication, that's real and it hurts and it's brutal. Nobody up here is pretending otherwise. So why is this the moment to look forward instead of back or just halt, frankly?
Because you can't drive forward in life by looking into the rear view mirror, right? Here's the issue: if you have to have a forward looking perspective, because look, unless you have a time machine and you can go back and not make any mistakes, that's great. I don't have a time machine, and I don't know anyone else that has a time machine. So because we can only go back, we can look at history, we can see what has happened in the past, but we still need to have a forward perspective and look at the data. Think about
Hmm.
it this way: this is a generational buying opportunity, but compare it to the last generational buying opportunity right after the great financial crisis, 2008. Folks that bought in 2010, 2011, 2012, well, you don't hear them complaining, or at least I don't hear them complaining. They bought at a time where it was very psychologically uncomfortable to buy. Now, look, in hindsight, we can look back now and say, oh, what a great time to buy. You bought this asset cents on the dollar. Well, it was very mentally uncomfortable. I lived through it. It was very mentally uncomfortable and painful to buy anything at the time because
Right.
you literally thought the world was going to end and we were all going to live in a tent.
Hmm.
So, this
Hmm.
is not a feeling, though, by the way. The data points it out, but this is a psychological issue. The time, it's like a cycle where it is the most psychologically uncomfortable to invest, that is the best time to invest typically. And wherever it is the easiest to invest, that is typically in the long term the worst market to be investing in. But the data says we are close to or near the bottom somewhere. Look, cap rates are flatlining, values are stabilizing now, and institutional money is now coming in.
Hmm. A cap rate is the unlevered yield on a property. With cap rates, or when cap rates stop rising, prices have stopped falling, right?
Yeah, yeah. Look, and again, this is what a view typically from the bottom looks like. Cap rates have not moved in the last 7 quarters. This is the longest flat stretch in the last 25 years. Fundamentals models are all pointing to we're at or near or somewhere near the bottom. Okay, nobody can predict the bottom to the second decimal point. And the most sophisticated capital in the country, it's not the world, institutional capital, now is calling multifamily the best real estate sector for the next decade because it has taken so much lumps and
Hmm.
demand is still strong. So, again, none of these are promises, right? These are forward looking projections, returns are targeted, but the weight of the evidence is not just pointing in one direction. Past precedence also tells us the same thing. But just look, think back. This is mean reversion. When things go up, things go down. And for all the folks that bought in 2011, 2012, 2013, we can now say, wow, you got a deal. But at that time, it's pretty hard. I can tell you that. And none of those folks are complaining today. So the folks that bought then did not buy because it was easy. They bought because they let the data speak to them.
Yeah.
Similarly, the folks that are going to buy now at the bottom, it is going to be very uncomfortable, but they are the ones that are projected to be making money hand over fist, no questions asked.
So we've been speaking about this storyline, right? There's the sponsor, there's the lender, there is the balance sheet. I want to put these all together and lay it out for everybody clearly. And really, the best way to do so is to describe the prisoner's dilemma with it being really on steroids.
Yeah.
So let's turn the page to just the classic version. Two prisoners are held in separate rooms, each one acting purely in his own self-interest, making the choice that leaves both of them frankly worse off. Not because either is stupid, but maybe desperate, but because none of them can see or trust what the other is really doing. That is this market with three players instead of two. The sponsor, number one, protecting himself, sells rather than pour in more of his own money. Again, maybe because that money has been exhausted. This is rational. The lender, protecting its equity from the creditor above, forces the sale instead of waiting. Again, rational. Third, the investor, protecting his remaining capital, refuses to fund the rescue. Third, rational piece. So three parties, each making the individually correct decision. And the sum of those correct decisions is a forced, discounted sale that hurts all three. Nobody defects because they are greedy. They defect because they're trapped. And none of them can afford to be the one who waits.
Look, the interesting thing is the one entity or the one thing that is, excuse me, the most stable in this entire thing is a building. It's full.
Yeah.
Demand is at a record high. It's the healthiest party at the table. The issue, though, is it's ju- it's just presenting a very attractive entry point. This is a generational buying opportunity, not a broken asset. You're not buying these broken assets at the peak of the value market. You're buying these at a significant material discount. This is a healthy asset. It's just that all three of the major entities, the sponsor, the lender, the investors, they are all their balance sheets are not allowing them for structural reasons to come to an agreement to amicably solve this issue.
Hmm.
It is hard. That is the whole point. Otherwise, this opportunity would not exist. You can't go online. There is no big headline. There is no big auction that tells you, okay, today we've hit the market bottom. The next 10 years are going to be great. There's going to be no grand announcement like that, right? These are private conversations. This continues to be a relationship driven industry. And I believe they're fundamentally going back to what real estate really was, a slow but consistent and steady growth investment that just prints money left, right, and center, but slowly does it. It's not a flashy thing, it's a consistent thing.
Hmm. Hmm. No, that's a good point. The asset's not going anywhere really, right? These three characters of the story, they're going to pass away, but the asset will move forward and there will be those three characters reemerging who capitalize on the situation.
Yeah.
So, um, you know, there's private conversations going on, Omar. Is that because the lender does not want the highest bid?
Oh, no, no, no. Lenders want the highest bid. Everybody, look, you want the highest asset price for your asset. I want the highest price. It's just that they value certainty of closing more or surety of closing. That is the most valuable currency because what happens is a group that's closed before has got a great track record, qualifies for agency financing like we do. They will probably not retrade at the last hour or not like screw up for stupid reasons. Versus a flyer, somebody you don't know has no track record or is kind of like, not like the best track record. Yeah, they might say they'll give you 10% more. But that 10% more might as well be 0% because they're not going to close on the deal. So now you're going to go through this entire process for 2 or 3 months because again you can't press a button and sell these things, right? You're going to go through this entire process for 2 or 3 months and you're going to have egg on your face. So what lenders are prioritizing, while they want the highest price, they are prioritizing surety of close with
Mhm.
most highest quality operators.
That makes
And
sense.
lenders, as an examples, do not call us because we bid the most. I mean, I wish I had that kind of money. I don't have that kind of money. I'm a cheap guy, right? They call us because we close, we've got a consistent track record. And this is not a market where you shop. It's not like going to bazaar and you shop and you're like, all right, I'm going to get this at a discount and that at a discount. No, this is a market you get invited into. And the
Mhm.
invitation is your track record.
Yeah. Yeah, there's no time to shop around is part of it, right? There's people in hot water. There's no time to do so. So certainty is incredibly valuable. Omar, let's round out this whole webinar. Bring it home right now. What's the main statement throughout this whole hypothesis theme?
Well, the last 6 months, we have given you an inside institutional operators look into this cycle. We've torn the cycle apart from backwards looking, what's happening right now, where the market is going. This is where it lands. Fundamentally, the buildings and the industry is healthy in the sense that this is not like office again. It's not like, oh, I have this office building. Even if I get financing, I don't even know if I have a tenant to lease this building.
Hmm.
We have the opposite problem. We have the record demand. The sponsors, the lenders, the investors, they're all squeezed right now by the balance sheet above them, which is the lender's lender. And the squeeze, the structural reasons are shaking all these assets loose and providing very, very, very attractive entry points. And the people who move at the bottom right now, where it's psychologically uncomfortable, they are going to spend the next decade looking like geniuses. And the data backs it. Cap rates are flat. Fundamentals are saying this is markets bottoming out. I mean, look, values are well below 2021 peak. In fact, values are now at 2016 levels in some markets. So think about it.
Yeah,
We have spent 10 years to go back 10 years in time.
yeah,
We
yeah.
went forward 10 years to go back 10 years in time. So Shelby Davis, I think, to sum it up, puts it best. It says, he said, you make most of your money in a bear market. You just do not realize it at that time.
That's right. That's right. Yeah, no, it right now is the most uncomfortable time, and we're completely being honest with that. But there's also the most opportunity, right? It's taking this distressed situation and turning the perspective on it, right? Looking at it from a different angle. And that's been the point of all these webinars. So we do these every month. We'll keep on pulling the next thread of the story as the market gives it to us. So we'd love for you to come back next month. But if you want to talk about how any of this applies to your situation, Omar and I are always reachable. Omar's email is omar@boardwalkwealth.com and mine is miles@boardwalkwealth.com. But why don't we open it up for questions? We have a good audience tonight. Please use just the Zoom Q&A to provide a question. I do have a cheeky question, Omar, to begin with that I'm not sure you can answer.
No,
Which
no, no, hold on. Larry, I will, how about, Miles, please make a note of that. Larry, we'll email you. I don't want to say that publicly. The answer to your question, the question is basically which Dallas company lost $400 million. I'm not going to say that publicly. They're a very sophisticated, smart operator. Again, I don't know them. I have no dog in this fight. But yeah, I'll email you. Don't worry about it.
Perfect. Okay, let's see. The second question here is um, if demand is so strong, why are national rents basically flat?
Well, this is, again, economics 101. This is a supply story completely. While we have record demand, we had more than record supply. In fact, we have now digested the biggest supply wave since I believe the 1980s. Yeah, 690,000 units at the peak. And that supply has overwhelmed Class A. So now you're having Class A coming at discounts, which frankly nobody's ever seen before. It's dragging the headline rates down. But now
Mhm.
most, if not all of the supply has been digested. Class B and C rents are much stronger and firmer. And but demand continues to be strong. Guys, look around you. You
Yeah.
don't have to take my words. You don't have to take Miles's word. Look around you. We have an affordability crisis in this country. And we've had it for a long time. And it used to be that if you lived in, say, Southern California or San Francisco or New York, or maybe Seattle, right? Yeah, those coasts or Boston, those were the expensive areas. But if went to a Florida, you went to a Texas, you went to Chicago, these were affordable places. Well, the problem is the affordability crisis is even hitting these affordable places.
Yeah.
So
Yeah.
fundamentally, where are these people going to go? Unless we all decide to live by the, I don't know, by the lake or in a pod or in our cars, people want quality, affordable housing. This demand is continuing to go up as long as the affordability crisis stays in this country and interest rates keep going up. This is this is not speculation. We see it in our communities everywhere. I mean, it's hitting places in the Midwest now, which used to be the most affordable places in the country.
Mhm, mhm. Yeah, the point is, point blank, the demand is not discontinued, as we spoke earlier. It's just that that absorption has now basically reached its peak. While it was reaching its peak, of course, rents would be flat. And what we're saying is that take a look ahead of that and see that clearly there's this opportunity building where that absorption will be complete, and then rents will have to react to a demand that still exists. All right, Omar, do you see a question here you want to pick up on? I think there's a few. How about this one? I lost money, and sadly, this is not an uncommon question or situation. I lost money in a syndication. Why should I put another dollar into this asset class or multifamily in general? Omar, you're muted, my friend. You are muted.
Sorry, what happened to my look? The honest part is your loss is real. I don't want to minimize it. I think you should look. Even if first of all, you should be cautious because you've had a loss. I 100% agree with that. But even if you didn't have a loss, I would still be cautious, guys. I'm on record in the last 10 years. This is when the market was going bananas, upwards all the time,
Hmm.
saying, "Do not give money to most of these people. These people do not even know the basics of accounting. They cannot even balance their own checkbooks." I mean, how are they going to manage your money when these people barely graduated high school, if not college? They cannot. I mean, not that it's like a barometer of intelligence. It's not like everybody that goes to college is intelligent. There are lots of idiots that go to college. But my point is, these people can't balance their own checkbooks. Every Tom, Dick, and Harry that couldn't get a real job suddenly was becoming an influencer to try to teach people how to become rich when they themselves are broke. I mean, Jesus, this is like going to a dentist with bad teeth. Or you go get you get a personal trainer. And no offense, but if your personal trainer is fat, uh, not a good look. That's all I'm
Yeah,
gonna say. So look, I totally understand, but you have to separate a broken capital position from a broken asset class.
yeah,
Your
yeah.
asset class is office. Fundamentally, you are having a conversation of whether this is even an investment that should exist, period. This is like owning a horse buggy company when the car is being introduced. You
Hmm.
have a fundamental question there. But in our particular niche, the fundamental question does not exist. The issue is we've had broken capital stacks. The buildings are still printing money. The debt and liquidity on top is killing these buildings. And the sponsors, as an example, or investors who invested, as an example, after the last crisis or any crisis before that, the savings and loan crisis, the RTC time, 2008. Well, they made the best returns. Those vintages were the best in the decade. So, diligence the sponsor's balance sheet, diligence the debt structure this time around, not just some glossy presentations or just like a glossy pro forma because some guys like a nice website.
Yeah, that's right. Omar, I've had a lot of these conversations, and at the end of the day, this isn't about twisting anybody's arm. We totally understand that that's not a fun place to be in. And again, rational and understanding for you to look elsewhere. The point we're trying to make is just this: keep your eyes on multifamily, be more scrutinous than ever before, do all the due diligence now that you've been equipped with knowledge to do, but keep your eyes on multifamily because there's opportunity that still exists, and that's why I wanted through this webinar series to unpack the why behind that.
Yeah, yeah, I agree. So, what's the next question we got?
All right. Rates may stay higher for longer. Doesn't that break the thesis?
Actually, no. The thesis does not depend on rate cuts because the price you are getting today is bottom of the barrel pricing. So, I'm using us as an example, but again, we're not the only people in the world doing this, by the way. We are buying at or below the loan balance. Just today, we're looking at a deal in Georgia where we are getting an agency loan sub 4% rate. We have to assume it because the other guy didn't know how to operate out of a paper bag. But again, the prior equity is wiped out. So we're acquiring at or below the loan balance. We're then taking, if these are not agency loans, we're very quickly taking them into the agency loan product. And anybody that does this will tell you the agencies are the hardest loans to get because you need to not only have a pristine track record, you need to have a stellar balance sheet, a lot of liquidity. So now that's what we're doing. And by the way, if rates fall, that's just upside. Because if rates fall, then the person buying from us has a higher capacity to pay. Ergo, they will offer us a higher price. It is a more easier accommodative market. But
Yeah.
if the rates stay where they are, we're typically getting fixed rate financing. The deal works for us. So we're not underwriting to a rate cut. We're underwriting to what is the value that I can get today and how cheap can I get that value.
And the whole point is to mitigate risk altogether, right?
Yeah.
So, it's not saying that rates won't go up, but then we mitigate our risks in a variety of ways. And one is to get these properties at a basis that really was unheard of in the past, Omar.
Yeah, look, I told you, we are now pretty much going back in certain cases to 2016 pricing in certain markets. I mean, we've gone
Mhm.
forward 10 years to go back 10 years.
Yeah. Last question. I want to be respectful of everyone's time, but this is a good one. If the asset itself is not the culprit, why can't the current owner just refinance and keep them?
Guys, the short answer is they don't have the money. The long answer is there's a refinancing gap. Off, say, the 160 whatever $1 billion of loans, as an example, that are expiring this year, $115 billion of these loans cannot even cover their debt service today. They cannot cover it. So now the asset qualifies for a loan, but if the sponsor goes and say goes to the lender, and let's assume their loan was $30 million, the lender says, okay, the new loan at the new rate is going to be $25 million or $22 million. Well, they have no money. So what are they going to do? Their loans are expiring. They got no money. They have to go sell the asset. It's not like they want to sell the asset. It's not like any sponsor does all of this work. The lender does all of this work, and they want everybody to lose money. It's not like we give people are in the business to lose money. It's just that these things are happening, and it's not like the building is failing to refinance. It's just that the owners and the investors do not have the money to bridge the gap, and the lenders are not in a position to help them do that. That's it. It's simple.
Hmm. Hmm. Well, Omar, I think that is everything for the questions. None have come in. Any parting words of wisdom before we reconnect with everybody next month?
I mean, I think wisdom is a very grand word to describe whatever we're discussing. My thought is, guys, you should always have a forward-looking perspective. If you have taken a loss, I'm sorry you've taken a loss. I understand if you've invested in other people's deals, it hasn't really worked out. But we can't go forward in life by looking in the rearview mirror. Unfortunately, that's just the way things are. Because if I could go back in time, I mean, I'd be a billionaire and I'd probably be owning an NBA team right now. But that's just the way life is. Have a forward looking approach. Look at what other successful, thoughtful people in the past have done. And in every cycle, when you hit a bottom, it is very psychologically uncomfortable to invest, but that's when you find the best deals.
Perfect. Thanks, everybody. Thanks, Omar. Appreciate your time, and we will catch you soon. And do reach out if anybody has questions. Thanks.
For now.